The sell-off in U.S. stocks accelerated on Tuesday as the Dow and the S&P 500, they dropped for a fifth straight day. Now, this comes on the cusp of earnings season. The slide marked the S&P 500's worst day since December 8th last year. All S&P 500 sectors ended in the red, with industrial and materials suffering the biggest drops. The Nasdaq also slid below its 50 DMA and closed below 3,000 for the first time since March 12th. The Dow lost a good 214 points on closing bell. The S&P 500 index, that knocked down about almost 24 points, and the Nasdaq as well tumbled 56.
What about Asian markets? And Asian markets are firmly fixed in the red. So we start with the big ones. Let's start with Japan and Hong Kong. Japan has taken a knock of 1% plus on your screen, 92 points down. Hong Kong has taken a knock of 220 points. That's knock off nearly 1%. China is also trading with a downward bias. And if you check on SGX, SGX is clearly telling you the real story. Global volatility in last 8 trading sessions has shot up by 30%. So the problem is not local. The problem largely is global. Why are global markets correcting? Well, the factors will just come up on your screen. Factor number 1 is that the US economic data of late has been poor. Spanish bond yields have gone up, which means money seems to be drying up. Global volatility has shot up. And most of the global brokerages are of the view that S&P this time around will only report a 1% uptick when it comes to quarterly, when it comes to Q1 earnings, and margins in Q1 actually have peaked out. So it's one, you've got problems in Europe, concerns of Asia, and then Spanish bond yields. So it's a mix of 3 factors which is dragging us down. Seth Freeman joins us, represents EM Capital Management. Seth, morning. Thank you for joining us. What was the key reason behind last night's decline in US equities? US jobs data, concerns in Europe, or simple profit booking?
Well, I think the biggest piece is the situation in Europe with the Prime Minister of Spain suggesting that a bailout is going to be necessary.
Seth, increasingly it seems like the real threat when it comes to Europe is actually Spain and not Greece.
Well, Spain's a much bigger economy, and it's coming to a head now. Although we are hearing indications that Greece will be back for more, and there was news of a sea worker strike today.
Seth, do you worry about the course Q1 earnings could take this time around? Because I was looking at a Bloomberg report, and the consensus on Wall Street is that this time around S&P earnings for the quarter gone by, they will grow by only 1%. That's minuscule.
Yes, it truly is minuscule, although we had very strong earnings gains in previous quarters. The good news is that oil went down today and stockpiles are up. So maybe the overhang of concerns about rising oil prices will soothe the market.
So, Seth, at a time like this, what about the emerging market outlook? At a time when you are seeing the Dow knocking down about almost 200 points, there's concerns about Eurozone as well, as is the case with China. What's left of the rest of the emerging basket?
Well, I think it's looking very good for emerging markets. It was reported that 8 billion more money went in the last 2 months to emerging markets, which is about a quadrupling of what went in January.
Said so for the rest of the year, are you a dollar bull or are you a dollar bear?
I think we're probably a dollar bull, considering what's happening in other economies. And although it's certainly not very robust, we are having some measurable growth.